What's going on, everybody? Welcome to another lesson. In this video, I'm going to talk about the risk profile associated with the 4 trades that we've talked about so far in this course. So we have the option to buy a call option, buy a put option, sell a call option for a premium, and sell a put option for a premium. And in this video, I'm going to break down the maximum risk and the maximum reward for each one of those trades. So when we talk about risk, what I'm referring to is understanding exactly that, understanding the maximum upside and the maximum downside for each trade, and then managing your risk accordingly to your own strategy, your own personal preference, and how experienced or good you are at actually trading. You can do this and manage your risk by implementing a couple of factors. Number one, though, is just making the right trades and understanding your trades. After that, you can hedge your bets and you can also implement a stop loss to help mitigate some of your risk in these trades. Now, when we talk about the first 2 options, the first 2 trades in this course, we talked about buying a call option or buying a put option. The idea here is that you're paying a premium in order to get the option to buy or sell a specific stock at a specific price on or before an expiration date. In this instance, when you get these contracts, you pay that premium, and if that stock does not hit a certain price before or after a certain date, then that option becomes worthless. Therefore, in those cases, you will lose your entire premium. When that happens, you will have lost your entire initial investment, 100% of your investment. However, you will not owe anybody any money on top of that. So the risk here, when you buy a call or a put option, is 100% of your investment could go completely to zero on or before a specific day. That is the risk profile when you buy a call or put option. When you buy a call option, you have the opportunity for unlimited gains. If you have the right to buy Apple at $400 and it goes to $800, it could even go to $1,200 or $1,600, and you're going to make a drastic amount more money. However, when you buy a put option and Apple is at $400 and you have the right to buy it at $300, it can only go down to $0, meaning you only have the ability to profit $300 on that trade. So a put option has a maximum upside. There is a limit to how much money you can make on a put option, and that's determined by the price of the stock. A call option has no maximum on how much money you can make, and if you're Kodak and you go from $40 to $300, you will make all of that money, and there's no limit on how much money you can make. So buying a call or buying a put option have great upsides and they have limited downsides. That downside is limited to 100% of your investment. So you can very easily lose 100% of the money you put in, which is why you need to be very careful when you're trading with options. Now, when we talk about selling a call option to open, what I'm referring there is taking the other side of that trade that we just talked about and selling the premium to somebody that wants to buy that option. So what's actually happening there is you are borrowing that option from the bank, you are selling it out to somebody, and then you are saying, I will cover this option in the event that the stock price is above the strike price on expiration and you decide to exercise. So the downside here is you are taking the other side of that call option and you now have unlimited risk. Just like when somebody buys a call option, they have unlimited upside. This is the other side of that trade, and you now have unlimited risk when you sell a call option and collect a premium. If the stock goes up, you have to cover that call option. So if Apple goes from $400 to $800, you have that $400 difference that you have to cover, and you will have collected a premium on that to help you out a little bit, but you have to make sure that you understand this risk because it is unlimited if you do a sell a call option, collect a premium, and don't do any other trades with it. The maximum gain on this is only 100% of your investment. You can collect that premium and you can hold that entire premium if that option expires out of the money and it expires worthless. So the upside here is 100% of your investment. You get to keep at expiration. The downside here is unlimited loss. If Apple skyrockets, you could be on the hook to cover that difference the entire way through. This is without a doubt the riskiest options trade, and it's usually only used to hedge bets and in combinations with other options. I do not recommend you ever putting out just a sell call option to open because it is the riskiest type of trade, and I do not recommend you ever doing that. The last type of trade that we've looked at is selling a put option to open. This is the idea of selling a put option for a premium and covering that put option in the event that the strike price is below the stock price is below the strike price on expiration. In that case, the put would be in the money and you would be on the hook to cover that difference. So the idea here is you can lose more than 100% of your initial investment. You can lose more than 100% of your initial investment. For instance, if you sell that put option and you collect a $1 premium and the stock is currently at $5, if that stock goes down to $0, you have a $4 difference in there that you have to cover. So you have a maximum downside of 400%. If the stock price was at $10 and you collected a $1 premium, it can go all the way down to $0 and you have a $10 difference that you have to cover there. Therefore, you have a 1,000% risk on this trade. Now, the maximum loss here, exactly what I just said, is the current price of the stock minus the premium. So if the stock price is $10, you collect a $1 premium for it. That means it's currently $9, and if it goes to 0, you could have to cover that difference. So your risk when you sell a put option is basically the price of the stock minus the premium. Now, if the stock doesn't drop like that and the stock is out of the money on expiration, in other words, your option or the option that you just sold expires worthless, you will be able to keep 100% of that premium, meaning that your gain on that trade at expiration will be 100%. You will get all of that money back and you will not have to cover anything. So your maximum upside when you sell a put option to open is 100%. Your maximum downside can be more than 100%, and it can be up to the price of the share minus your premium. So you need to understand that math, because when you sell a premium, the downside is usually much higher than the upside. So that's why it's a little bit riskier, it's a little bit more complex, and that's why when you sell the premiums, you're using time to your advantage, but you pay a little bit more for that. So these are really important things. You need to understand the maximum upside and the maximum downside on every single trade you make, because when you start to combine these options, it gets a little bit more complicated. And that's exactly what we're going to start doing in the next videos. So please stay tuned, but please make sure you manage your risk. Do not overexpose yourself. Do not overestimate how much money you think you're going to make and the trade goes wrong and you're in a bad position. Those are very, very bad mistakes that you don't want to be in. So please be careful, understand your risk, and make sure that you're paying very close attention and doing more research than just this course. You need to do more than what I'm showing you, because I'm only just covering the basics and covering all the high level stuff. There is more that goes into this, especially when you start playing with different platforms. So continue your research even past this course, but please consider writing a review, because I sincerely appreciate it. So thank you so much. On to the next videos.